Good morning, everyone. We are now on week number 11. So we're on the tail end of our course on finance. And then this week, we're going to talk about dividend policy and then retained earnings. So before we go there, wanted to make sure that we have the terms clarified, right? So what is a dividend? A dividend is an amount that the company would declare um, for those who have shares of stock, or if you're an owner of the company through shares of stock, they would declare a dividend payment, meaning that the company will give you an amount based on per share. Say if you have 10 shares and then I give you $10 per share, then you have $100, right? That you would receive for the stock that you own. Of course, if you are a retail investor like you and I, it's not a lot. But if you are an institutional investor, that can be a big amount. Or if you hold a lot of stocks on all the companies, that's actually a good thing also as well. Now, one thing to keep in mind is that dividends can be a strategy for retirement. I know you guys are way too young for retirement, but something to think about is that think about this way. At one point in time, you're going to be investing in the stock market. And then, depending on whether you're doing it on your own or you're asking an advisor, right? Meaning a Vanguard, a mutual fund advisor, or through a brokerage company. Now, a strategy can be wherein you would actually compute the amount of dividends that you would like to receive as passive income each year, and then basically say that this is your passive income through dividends. So that's why you want to keep a portion of your investment to those companies only. Like big companies that do declare a lot of the dividends will be Coca-Cola, um, things that are consumer products, Procter and Gamble, Unilever. These are companies that contribute a lot of dividends on a quarterly basis to all of its shareholders, Coca-Cola. And then that can be a strategy for retirement. So you're not pulling away your investment on your retirement fund, but you're allocating it to a high yield, high dividend yield stocks that the generation of the dividend will be passive income to you. So that's one way of thinking about it. And then that would be good for you to understand that, hey, you know what you learn here in finance is not just all about a company setting. It can be reflective also of what you want to do there in life as a retirement policy or a retirement strategy. Now, going to the discussion on the definition, what is retained earning? As the company earns net income, that net income is actually closed, as we say in accounting. It goes into a retained earnings account or in the balance sheet. Net income is an income statement account, and then it gets closed or it goes through the balance sheet account through retained earnings. Now, that retained earnings account basically is an accumulation of previous year's net income. Of course, that retained earnings can be used in two ways. It can be used, that retained earnings, to be distributed to the shareholder through the form of dividends. At the same time, that same net earnings can be used to be reinvested back to the company by using the funds for major projects, funding of major projects, and anything else. Those that we discussed in the capital budgeting discussion. Now, that's why you wanted to make sure that if you keep the money as a company through retained earnings and not declared as dividends, your shareholders are actually earning a higher rate, right? Based on those projects. Remember the discussion on the IRR? So your IRR should be higher than your cost of capital or your weighted average cost of capital. So that's the big premise, or that's the premise for this week's discussion. I'm going to go through the discussion point or of our learning objectives. So this time around, we're going to be discussing mostly through PowerPoint. There are some calculations, and we have a quiz this week, and then those calculations are also embedded within the PowerPoint. So no Excel file to be attached for this week. I'm gonna go through the discussion on, let me just like go through here. So we have some principle that we needed to talk about. So we have the marginal principle of retained earnings. So what is the marginal principle? So it's basically saying that um, what you keep on the retained earnings should be something wherein the rate of return is actually higher, meaning that you have two things, right? If you're part of the leadership team within the company, and then you realize net earnings, or you realize basically you earn net earnings or net income. It will be close to the retained earnings as we discussed a while ago. And then you have two things. Marginal principle would mean you would keep that net income on your retained earnings if you think that investing it on projects wherein it will be using internally generated funds, basically retained earnings, will provide a higher rate of return. So meaning that for discussion purposes right now, if you think that your project will actually earn, you have $1 million of net income, and then I can have that net income declared as part of dividends. Now, only if the marginal principle says that, only if um, giving it back to the shareholder will be of a higher value to the shareholder compared to using that funds on a higher rate of return project, right? So that's basically the marginal principle of retained earnings. Why? Because you're doing it for the benefit of the shareholder. What is most beneficial to the shareholder? Is it better for the shareholder to receive the dividends, or is it better for me, the company, not to declare dividends, keep that money and fund businesses or fund projects that would generate higher returns compared to giving it directly to the shareholders. Basically, that's what we are thinking of, right? So that's the marginal principle of retained earnings. Now, here is actually the life cycle of a company. So how do I say why is it a life cycle? Because the company at its start, you are on the development phase. As you go through the business, you are on a growth phase. And then you are stabilizing. So basically, it's not, you're stabilizing the growth, but you're trying to expand. Like think about more mature companies, like say, Apple or tech companies. They're on expansion phase. But now, when you think about it, depending on your timeline, right? Apple might be focusing only on phones and then also the App Store. But now they're looking at augmented reality using the VR headsets and whatnot. So they can still be considered on a maturity side of things on technology unless they implemented the Apple Car or new things, right? So in the future, so Apple might be on between. So here's the growth cycle or life cycle of a company, from development to growth to an expansion, and then later on there will be a maturity or decline. So there's like four phases. When you're on the maturity phase, either you just continually have a constant growth, and then or you're gonna be declining. Like for example, like Coca-Cola has been a company, and Pepsi has been a company for the longest time. But they're on the maturity phase because they're having some, I would say, existential questions, right? With regard to people wanting not to drink soda because it's not healthy for you. And then that's why Coca-Cola is trying to do a different way of marketing its product, or developing actually its product, right? Interestingly enough, when you go to Japan, there's a Coca-Cola that's colored white. I don't have a picture right now, but I always drink it when I go to Japan, or if I go to a Japanese store here in Guam. And then it's the one that helps you, I think it has fiber, Coca-Cola that has fiber. And then it's actually, you drink it, and then I guess you feel good when you drink it, right? because it helps you not absorb much of the fatty food when you eat in Japan, something like that, or the fried food, tonkatsu and whatnot. Now, so that's why those that are in maturity is trying to have some constant growth by creating new products or whatnot. So that's like Coca-Cola. Now, as we talked about the life cycle of a business, you can also relate it to the dividend policy. And the dividend policy are actually here. I made some modification on the PowerPoint file. I added some context here, and then I added some items here also, just to be sure it's more reflective of what you have as a content on your books and whatnot. So what are those on the dividend policy using the life cycle? When you are a startup, you're trying to develop your business, you are on the development stage, there's really no cash dividends. Why? Any income that you generated, you want to use it back to the company as retained earnings or internally generated funds to fund your projects. Now, if you are on the growth phase, you might have some dividends, but these are low cash dividends. Or if anything, your dividends is not in the form of cash. Why? You are preserving cash. You're still on a growth phase. You're preserving cash. You want to use the cash for your projects, but you might want to entice your shareholder to believe and give confidence in you, in your management team, that you are giving them something back in return because they invested in your business. So that's why there might be stock dividends, basically increasing the number of stock that you have compared to what you have invested initially, right? So in a growth stage business cycle, your cash dividends is actually low, and then you might give stock dividends. So earnings are still reinvested. Dividend payout is about 5 to 15% of earnings. Now, earnings will be net income. If you stack all the net income, it will be retained earnings because you retain it. So just to be sure that we're clear with that one. Now, if you are on an expansion mode, so here, expansion mode, you are still doing stock dividends, but now it's actually low to moderate cash dividends and maybe some stock split. We're going to talk about stock splits, but stock split is basically, um, I will give you, if it's more than 20 to 25% of a stock dividend, it's technically termed as a stock split. Why do we have a separate term? Because they have a different accounting treatment, which we're going to go through later on the PowerPoint or as we discussed it. Now, stock splits you can do one. If you have one stock, I'll give you four for every stock that you own, or it can be a reverse stock split. If you have four stocks, I will give you one. We'll talk to you about the pros and cons of a stock split and a reverse stock split later in the chapter or later in this discussion. So during the expansion, the firm is more capable of paying the dividends. Why? Because it's been retaining most of its net income. So that's why the dividend payout is about 20 to 30% of earnings. Okay, so let me just close out. I help out with the POS if they have issues. So that's why people are logging into their POS right now. And then, so the firm is more capable. And then now you can see that the dividends from the growth to the expansion is higher. How high? From about 5 to 15 on the growth phase to 20 to 30% in the expansion phase, right? Now, on the maturity phase, like the Coca-Cola, Unilever, Procter& and Gamble company, the more established, more than 50 years, more than 100 years type of company that's been in existence, like your consumer goods, I would say, consumer goods, they are on the maturity phase of the business. So the dividend payout is about 30 to 40% of earnings. So when you look at it, businesses are actually different on sorry, depending on the business that you are actually in, you have a different policy. So a tech company might be doing a lot of reinvesting, but when you're actually on a consumer market, like not the tech, it will be on the maturity stage. It will be a higher dividends um, declaration or giving the dividends. Now, so what are the decisions? I made some snippets over here. So when a company earns a profit, it can either pay dividends or reinvest, right? So as a review, the marginal principle suggests that the company should retain earnings if they can be reinvested at a rate that is higher than what the shareholders could earn if the funds were distributed to them. Let me dissect this one just to be sure that we actually can apply some of the discussions that we had before. So this section. So what do we mean by this one? It should be reinvested at the rate that is higher on what the shareholder could earn. So what does the amount, so what is that rate that the shareholders could earn? So that will be your rate of return or your KE. Remember KE or cost of equity, right? So cost of equity, KE, is actually either CAPM or either the dividend yield of the DDM, the dividend distribution model that we actually computed. So, or let's simplify it. Let's say, like, okay, there's too much formula to remember. So you look at the stock market right now. You look at the S&P 500, and if the market, the overall market, um, is actually at say 13% growth rate. So it would mean that the company would now think the S&P 500, which is the average of all the stocks, regardless of industry or representation of certain industry, the S&P 500 that comprise the major on Standard and Poor's, is at 13%. And then you can give the dividends to your shareholder, and then it should actually make 13% basically, because they would reinvest that money back to somewhere else. But if you, the company, had a project that would earn an IRR of say 20%, you just tell your investors, hey, I do not want to give you the dividends this year. I don't want to declare dividends this year because I know I can give you a higher a higher rate of return by investing on the projects that you lined up for with an IRR of 20%. So basically, that's a that's the marginal principle on dividend policy. It's a framework on how you need to think of whether you want to declare dividends or not if you are the CEO or the CFO of a company. Okay, so let me just go to the next one. So it's still going through that discussion that we have with the marginal principle. Dividends paid out only if the corporation cannot make better use of the funds for the benefit of the shareholder. That's why the marginal or residual principle is actually still applied, right? So there is a residual theory on dividends, which is actually similar to the marginal principle. So the residual theory suggests that the company should only pay dividends from earnings that remain after funding all the profitable investment opportunity. So this one is taking it a step further. The marginal principle says that, hey, do only declare dividends if it's actually going to be beneficial to shareholder. But if you have some projects that are actually a bit higher rate or with a higher rate of return or an IRR higher, then keep it. Don't declare dividends. But now the residual theory talks about, let's take it a step further. Let's consider your net income. Basically, here's the important one. Oop, let me just make sure it's a different color. How do you now compute dividend declaration? Here's your net income, but deduct from it anything that you have on a project. So what is your capital expenditure needed for a project that has a higher IRR compared to the rate of return that the shareholder expects, which is actually what you think about as the S&P 500? Then that will be your dividends. Then that's the amount that you need to declare. So that would be the amount of calculation of the dividends that you would want to do. And then you just divide it by the number of shares of stock. Then that will be your dividend per share of stock, right? So when you think about it, this one is actually showing net income. But technically, you can actually have it against retained earnings, which is actually a composition of net income for a lot of years. So net income, net income, net income. That's actually how we do it. So this might be in last year, 2023, 2020, or 2022, 2021. So if you want to declare dividends on a per year basis, you do it this way. But if you want to recompute everything, you can use the retained earnings in totality as of a given date. Right? So it's the same discussion, same concept. You actually declare dividends after considering and identifying all the funding needed for projects that are profitable. And then after that one, anything that you have deducted is actually the dividend that you need to declare for that year. Okay. Now, what's the relevance of the dividends to the point of view of the investor? So the dividends is actually a confidence booster for investors. Why? Remember, if you're the investor, you gave money to the business. After you gave money to the business, you would expect something in return. That's why you're actually investing. Now, getting dividends on a yearly basis gives you a confidence that the business is doing well. And then, oh, how do you actually do that? By understanding that if you have a discount rate, or remember KE, or an expected rate of return, hopefully the dividends that you get is actually higher than your expected rate of return. And then now we would actually go there on how to compute that dividend yield, right? I will go here. This is actually important. Let me just go here. So the logic part of it, companies, depending on whether you're mature or growth stage or whatnot, companies that are mature, they would want to give more dividends. We discussed that a while ago. I'll show you an example, right? For example, these are the companies that are actually big. Let's see the bigger companies, the dividend payment. So we'll focus on this one. The companies that give out the biggest dividend payments are the mature companies. For example, Cisco, which they've been there as a technology company, gives out 52% of their earnings as a payout. And then also you have, say, 87% for Southern Company, a utility company, because they're on the mature phase. And then also, for example, companies like Apple, it's actually there also high dividend yield earning. But those companies, tech companies particularly, that are in the development stage or they're trying to establish themselves in the market, like say Tesla, Under Armour, and then Lululemon, they don't declare dividends. Why? Because they are reinvesting the money back to the business, waiting for it to, because they believe, I would say, that reinvesting into the business creates a higher rate of return compared to giving it to the shareholder. The same thing that we were discussing a while ago. So these are the category of rapid growth company, and these are the category of slower growth. Not because they are not growing, but they're actually on their growth to maturity, expansion to maturity life cycle of the business. And I know these are on 2021, so that's why I'm thinking some of them, like Tesla, might now have moved somewhere here, right? Depending on. So this is an interesting chart that was actually made or like based on the S&P. So S&P Standard and Poor's 500 index. So it means that S&P 500 is the aggregate of the performance of 500 companies that represent the entire stock exchange or trading market. So different industries. When you think about it, your earnings is like here on that S&P 500, and then it did a dip. What happened in 2008 is the credit crisis. So the global credit crisis in 2008 happened. What happened? A lot of the loans got securitized, and meaning it became a stock, and then basically it's the credit crunch. Uh, um, the United States has been doing a lot of credit using mortgage or anything else in between. And then they were not properly capitalized, those who have been securitizing those loans or loan stocks. And then it just went to a domino effect, right? That happened in the global credit crisis in 2008. So that's why their earnings dropped for most companies. A lot of companies are asking for bailouts from the government sector. But what you can see is actually on the dividends. The dividends, it did a decline, but not so. See here, there's a decline, right? There's a dip, but not too crazy, because it's dividends needs to still happen. Like even here in 2019, it's actually during COVID, right? When the COVID news started to happen late uh, but it's I think if it's March 15, 2020, if I'm not mistaken, when the news of COVID happened, but or when everything got locked down, but like they've been having some discussions already for preparations for 2020. But you can see that dividends is also still consistent because that provides the confidence to the market or to the shareholders, even though earnings are not there. Why? Because they can actually declare dividends based on retained earnings, not just on the current income. So I'm going to stop there, and then we're going to do a two-part series of dividends. We're going to go to the second calculation or to the calculation part, but this is the introduction on the dividends part. Okay, thank you, everyone.